Hello, everyone. Glad you have joined us for this webinar surrounding the cash flow bonds. We're going to be talking about a lot of different things when it comes to the cash flow bonds investment opportunity. But before we get started in that, I want to go over a few things with you about our backgrounds. And so on the call with us today on the webinar, you have the three managing partners here that are running this fund, cash flow bonds. We have Kelly Garrett, Danny Randazzo, and then myself, Dan Hanford. And so I'm going to start off and tell you a little bit about my background. Then I'll turn it over to Kelly and then have her turn it over to Danny. And then we'll be going through the material today to kind of give you a better understanding of how this cash flow bonds investment opportunity works. So I'm actually a kind of a serial entrepreneur, if you will, have started multiple 7 and 8 figure businesses. And my core focus in the cash flow bond side of things is on the investment relations, investment services, as well as on the marketing side of things, kind of strategic objectives, kind of pushing things forward, if you will. And this investment opportunity has been something that we've been talking about for several years. You're gonna hear a lot about our background and our experience in the lending space. You can see there, even down at the bottom, our combined experience there. When it comes to over 2 billion in acquisitions, over 1.1 billion in loans that we have originated between the three of us. And so you're going to hear a lot about those different backgrounds and everything. But our primary goal today is to really give you some more education on what this fund is about. And then one little thing a little bit more about me. I'm married. I actually have 4 children. I live here in Columbia, South Carolina. And if you're ever in the area, feel free to reach out. Love to be able to meet up with you and chat if you'd like. But this opportunity is something that we've been working on for several years. We've been talking on it about it for several years, and we've been working on it for probably the last year plus. And so we're definitely excited about this opportunity to be able to present it to you. And so we're going to go into a little bit of a deep dive here. But at this time, I'm going to go ahead and turn it over to Kelly and let her take it over from here to give a little bit more of an introduction from her side of things as well. Kelly?
Thanks, Dan. I live in beautiful Charleston, South Carolina. I came here a few decades ago to play basketball here in Charleston and fell in love with it. So I stayed after graduating. I'm married myself for almost 25 years. I guess my main focus here at Cash Flow Bonds is on the lending side. I've been in the lending business now for 26 years. I flipped houses during that same time that I was a entrepreneur and opened up my first lending business. We flipped houses for almost 20 years, hundreds of houses. So the focus here for me is on operations of a lending business and taking care of all the back end of processing, servicing, asset management, risk management, and so forth. So that's a little bit about me. Danny, I'll let you pop in and tell us a little about yourself.
Thank you, Kelly. I am Danny Randazzo, the other partner here. Grateful to be alongside Dan and Kelly. And we just have a wonderful leadership team. I reside in Charleston, South Carolina, so I am frequently with Kelly, walking the streets together, or making phone calls to Dan and running our various businesses. So, like Kelly and Dan, an entrepreneur at heart as well. I've always been super passionate about finding a good risk versus reward and a balanced personal investment portfolio. That kind of got me into the world of acquiring investment real estate and then into the world of lending money and earning interest. And I've also been passionate about building out good relationships with folks in the industry. And what Kelly, Dan, and I have done is built out a tremendous lender-friendly ecosystem. We have some educational platforms where we're able to bring in lots of different borrowers, as well as varying lending products where we can meet the borrower's needs. And so over many years of experience in both buying and borrowing money, as well as lending money and earning interest, we've kind of come to learn that being the lender is a really great space to be in. It diversifies your capital across all of your loans, as well as it brings in interest income, which is just a paramount piece of profit for your personal portfolio from an investment perspective. So I really love the famous Warren Buffett saying of compound interest is the eighth wonder of the world. I personally believe that. I personally subscribe to that. And it's one of the reasons we're very excited about bringing this cash flow bonds offering to everyday investors just like you all and me. So let's move on to the next slide. And it's not just the three of us that do this. As Kelly alluded to, we've got multiple team members and great people around us supporting us. So within the cash flow bonds world, we have all of these beautiful smiling faces who help in the background: finance, marketing, underwriting, asset management, loan processing, sales, marketing, procurement, various players, various team members, and grateful to be surrounded by a wonderful team of people to really make this cash flow bonds a success.
Thank you, Danny, and thank you, Kelly, as well. So going over the agenda here, you can see that today, we're going to be going over an overview of cash flow bonds, and then what the return structure looks like in the various bonds, and then, of course, our strategy behind how we're going to be using these funds in a lending perspective. And so we're going to cover those things today, and then we're going to open it up at the end for some questions. So if you have some questions, feel free to type them in to the chat box, or actually we're not using the chat box, we're actually using the Q&A box. So find the Q&A box, and then please do hold your questions to the end, because we're going to be covering a lot over these next several slides, and you're going to be hearing from us individually to kind of cover some of these things. And at the end, if there's some questions, we definitely want to address those to make sure that you feel comfortable as you're moving forward, with this investment. You can see there's a disclaimer there that we're required to put out there in regards to our fund. So if you want to pause the video on the recording or something like that and read that, you can certainly do that. But let's go ahead and dive into the actual overview of the fund right now. And so these are kind of 6 things that we really want to kind of hit so that you fully understand what this investment is about. And so in the past, the investments that our primary group behind this fund is called passiveinvesting.com. And that company has done quite a few different types of kind of private equity investments, from apartment complexes, hotels, self-storage, express car washes, and of course we do have our lending arm to that entity as well. And all of those investments have been pretty much opened up to just accredited investors, basically people who have at least a minimum net worth of $1 million or more. So really just for millionaires, right? To be able to invest in those funds. And today with cash flow bonds, we actually have a fund that has a lower starting amount. So typically our investments, range between 25,000 on the low end upwards to $100,000 as a minimum investment into those different opportunities. And so, today with this cash flow bonds, you're now able to start with as little as $1,000 to start getting in your investing journey in place. And you do not have to be accredited. So this is open to everyone, not just those that have the ability to put in large dollar amounts. So this is something that our family and friends that are not accredited have been asking us for, and we have a lot of people in our network that have also been asking for it. So we're excited to be able to have this opportunity for you to start investing alongside us and see these institutional level returns that a lot of people are getting that are accredited, but now it's available to those of you who are non-accredited. The next thing I wanted to talk about here is you can see that this is a lender direct fund. So we're not really going through any brokers to be able to do these loans, and there's no hidden fees or anything like that. When I say brokers, like a lot of times we think of the stock market, right? You have to go through a broker or a brokerage firm to be able to buy those stocks, or you might have to pay some fees and things like that to come in and out. And if you're in some sort of a CD and you have penalties and things like that, or maybe some entry fees and exit fees, this is a lender direct fund that we are managing and that we are running as the lender. And so there's no hidden fees, there's no brokers, anything like that. And of course, you can see there that, it's also managed by experienced professionals. So we are leveraging the experience of the three managing partners that you just heard from myself, Kelly, and Danny. And then also the team that's behind us and that is supporting this and our other lending initiatives, they're also going to be coming alongside this and also helping with those lending initiatives as well. And of course, up here on the top right, you can see this is open to everyday investors. So instead of just having this available to people who have $1 million or more and are considered millionaires, this is open to everyday investors, and you can invest inside of this fund with as little as $1,000. So, definitely a low barrier to entry and open to anybody and everybody. This is what is called a Regulation A plus fund. And so that typically most of ours have been in a different regulation. Again, like I said, it's open to accredited investors only. This one is a Regulation A plus fund. It does take a lot longer time to get this kind of a fund set up. Because I'm going to kind of skip over this middle one here and talk about this being qualified by the SEC. So we are required, in order to do a Regulation A plus fund, to submit everything to the SEC and have them, qualify the actual offering itself. So it is qualified by the SEC, the federal SEC, and it also has third-party audited financials. So, on a biannual basis, we have to submit reports of the fund to the SEC for their oversight. And then we also have to have annual third-party audited financials. And so those are additional things that help you as an investor, know that there are other people looking at what we are doing. It's not just us telling you what we're doing, right? So it's an extra layer, an extra level of credibility, if you will. And of course, on the SEC side, it's an extra layer of compliance, if you will, because they require us to do things in a certain way. And we also have a third party broker dealer that is maintaining, our database and our compliance and maintaining the bonds and things like that are part of this investment. So a lot of different pieces, a lot of different moving parts on the back end that we have put together and that we are managing. And then of course you can see there in this middle section here, this fund also allows you to earn daily interest. And we're going to also talk about how it allows for daily compounding. And for those of you who may have heard of the word compounding, and maybe you've heard it in a monthly compounding format or quarterly or whatever, this one is what's called a daily compounding investment. And so what that means is that the interest that you earn on, say, day one gets added to your principal for day two, and you start earning interest on your interest. And that compounds and adds to the principal every single day. And so instead of just doing it on a monthly basis or a biannual or an annual basis, it's actually compounded every single day. So that increases the return for you over time. And so there are, as you can see here on your screen, there's three different types of options that we have available for these three different style bonds. First, you have, a 12-month bond, and that 12-month bond provides a 6% fixed annual return. Now, if you choose to, buy one of these bonds or invest in these bonds, and you want to lock it up for a longer period of time, say 24 months or 36 months, you will be eligible to receive that higher fixed annual return. So basically, there's three different options. There's a 6% return, 7% return, and an 8% return, and that basically is a 12-month, 24-month, or 36-month bond. And again, you can start investing with as little as $1,000 in this investment. I'm gonna go ahead and turn it over to Kelly at this point and let her go over the different ways that we are deploying your capital so you can kind of see how we're using your capital on the back end. Kelly?
Yeah, Dan. Danny spoke a little bit about our ecosystem, and I think that's very, very important here. One example is that, we run a very large real estate investment group here in Charleston and have found out that there is a need for different examples or different means instead of just 100% real estate backed loans. Okay. So I'm going to go through some examples of how our capital is deployed. One is the traditional core leadership back, core real estate backed loans, right? Um, an example here, again, I'm going to read a little bit through these so that you kind of understand exactly what we're thinking about. And we found out that there's a need for this, right? A regional manufactured housing dealer might need a short-term capital need to place some new homes in a community and then retail them out or sell them out. So that will be an example of maybe how we will deploy some of this real estate backed loans. Another is real estate linked assets. Excuse me. Example there, maybe, some of you multifamily people that might be on this webinar is, you understand that sometimes you need some short-term capital just to get finished a few more units before you can refinance into agency debt or any institutional debt. And you just need some short-term needs, capital needs. And then lastly, maybe some business owners. Danny both talked about both of them and myself. We're being entrepreneurs, and we've all run businesses and fell into this need sometimes of just needing some cash for upgrades or for equipment purchases. So we took kind of the community and our network and heard exactly the needs of what is on the street and kind of like put together a few examples of how we can actually diversify the capital in these three areas. And so by doing that, we're kind of anchoring ourselves in sectors where we have a lot of experience. And our track record gives us a strong foundation to protect the capital and position ourselves in long-term growth markets. So we feel strongly about being able to deploy the capital in three different asset classes to continue to protect the capital and once again position ourselves with our team behind us in good growth markets. So Dan, let's go to the next, and I think it's Danny's turn. I'll let Danny finish this up and go from here.
I think we're going to go straight into some of the questions and answers. And did you have something else to add in here, Danny?
No, I think Q&A it is.
Okay, good. Well, this first question that's come in, and for those of you who have joined us live, if you have a question, feel free to find that Q&A box and type in your question in there. Would love to hear from you and see what questions you may have that might be on your mind in regards to cash flow bonds. If you're ready and you want to go ahead and start investing today, the website is ready for you. You can either scan that QR code or just go straight to cashflowbonds.com, and it'll help walk you through how to get your investment started, and it'll help you kind of get things set up on the back end, to be able to get things rolling for you. Usually takes about 3 to 5 days for funds to clear and for things to come through, and so we'll be communicating with you on the background and the back end and stuff like that as you're submitting your information to be able to get things set up and started. So first question that's come in here is what is the typical loan duration? And this is probably more towards maybe Kelly or Danny, whichever one you want to take here. What is the typical loan duration on these types of loans, and how quickly is the capital recycled?
The average loan duration is less than a year, typically 6 to 9 months for the types of real estate backed loans. There might be special scenarios where you might go 12 to 24 months. But we try to keep it short term. Kind of that 6 month is the primary target where we're able to redeploy the capital one extra time in a 12-month period.
Okay. And what has been kind of the historical default rate or kind of loss experience, if you will, on other types of similar like business purpose style loans that we've been a part of?
I'll take that. On another private lending experience that we've all been in now for 5.5 years, we're less than 2%. And we've been able to, if we have problems of which everybody here, can anticipate death, divorce, disability, all the D's that happen in life, that if it were to happen, then, sometimes we have to either foreclose, take the loan back, take the deal back. And we're primed with the right people behind us to be able to handle that risk management and asset management.
Very good. A lot of questions around the kind of, what are the bad things that could happen in these style loans? So I do have one other question here that's come through. What happens if a borrower defaults, or maybe a loan goes into collection or something like that? Kind of, what's kind of the process on the background, and kind of what's the next steps for us to make sure that we're protecting investor capital?
Well, we have to take it to, if it's an asset-based loan, and obviously these are, besides the last asset-based loan, with equipment or with the business purpose loan, we're going to take it to foreclosure, and we're going to foreclose just like any county has to go through the process of foreclosing. And typically it's sold there, but if it's not sold there, worst case is we bring it back into house, we'd rehab it, we'd figure it out, and sell it ourselves. Sometimes in our past experience, we've just had to put a sign in the yard and sell it within 24, 48 hours and get a contract and sell it off. But there's also time. What makes us a little bit different is that, like I'd spoke earlier, about, is that, I brought almost 20 years of flipping experience, and everybody here on the screen has got flipping experience as well. And we've recruited people that aren't afraid to rehab a property if they have to. We're just not we're obviously a flipper's lender, but we also know how to flip. If we had to take the property back and flip it ourselves, rehab it and sell it, we will. And we're not afraid of that. Everybody on the screen has also run a business. If we had to take something back, we just bring it back into our network and our ecosystem that Danny talked about earlier, and resell it there.
Good. And some good questions that are coming in here. And another one is kind of towards kind of diversification, if you will. Like, what's kind of the plan in place for making sure that these loans are diversified across, maybe say, borrowers or geographies and different loan sizes, different things like that.
Yeah, based on our experience in the lending world, we found a good mix where you never want to give a high percentage of a capital amount to a single borrower. So we have a great methodology to, number one, vet borrowers, but then number two, ensure that we're not subject to one borrower having, more than 20%, or anything like that. So keeping the borrower diversification is important, and then keeping the diversification of the loans across multiple deals or assets is another important thing. It's one thing we manage very closely. We look at on a daily, weekly basis to ensure that, there's not much exposure to one specific location or region, to one specific borrower, or to one specific asset or asset type.
And it looks like we have two kind of final questions that we're going to take here, and then we'll wrap up the webinar here. The second to the last question is around fees that are associated with cash flow bonds and how do they impact returns. The nice thing, I'll take this one. So the nice thing about cash flow bonds is that there is no hidden fees. There's no like fees that we're charging that's going to affect your return or anything like that. The way we make our money is properly making sure that we place the money in loans that allow us to make money off the spread, is what they call it. So basically, if you are putting your money in at 6, 7, or 8%, we have to lend it out for a higher amount than that to be able to give you that 6, 7, or 8% return. So historically, we've been doing loans kind of in that kind of low end 12, 13, 14%, and upwards to close to 20%. And it's not just the interest rate; it's some of the fees that we charge borrowers and things like that get us to those return levels. But our primary way that we are actually making money off of this fund is off of the returns that we're getting when we're lending it out to a borrower. And so the nice thing is that even when there are defaults, there's a low chance or probability of it actually affecting any type of return for the bonds, because of the diversification of your funds across all of the loans that are in the portfolio, not just tied to one specific loan. And so there is a lot of diversification with this, and there's things that we're doing on the background to mitigate the risks of potentially having all of the borrowers go default all at once, right? We definitely don't want that kind of thing to happen because that could, affect the integrity of the fund itself. But this type of a fund is not something we just thought about, overnight and just decided, hey, let's just go throw this out there and see what happens, right? This is something that we've been managing funds for several years and have lots of experience in the lending space, the debt and credit finance space. We actually have three different finance companies that the three of us really manage and run and kind of own. And so we have a very large breadth and depth of knowledge when it comes to these types of funds and these types of this type of capital and placing it in good quality loans that has a lot of hedges around the protections for the capital for investors specifically. And so typically when a loan does default, if there is any type of deficiencies there, it's actually going to be coming out of our return from our spread, instead of coming out of investors. And that's kind of how we've done it with some of our other funds. They've been really successful. And so we're definitely excited about that with this particular fund. And then the last question I have that's come in here, I'll have either one of you, Kelly or Danny, kind of take this one. And then the question's kind of around kind of underwriting standards or credit criteria that the investment committee might use to be able to make sure that we are choosing and selecting good quality borrowers as well as good quality assets that are being backed by the capital that we're given to these borrowers.
Yeah. The most important piece of criteria is really the experience that we have. Some of the best borrowers in the world may present on paper as questionable, but they might be the most stand-up person and always do the right thing. And then on the flip side of that, you might have a borrower that checks every single box on paper and kind of what Kelly mentioned, death, divorce, a sickness, a life event may happen, and it could take that perfect borrower out at the knees, and they might default on their loan, and it would completely catch you off guard. We've been through that process. We've done loans to over 2,500 different borrowers just in the recent few years. And so that human interaction, that lender borrower relationship, that ecosystem that we've built is really what allows us to vet a borrower. We're still looking at their background, their experience, how they present. But there's a lot more that goes on from just a learned experience of doing so many of these loans, dealing with so many of these people. And of course, you got to plan for a borrower to have a life event in a situation to come up. But again, I go back to that ecosystem that we've built. At the end of the day, we want our borrowers to be very successful. We're not like the banker who always says no. We're not like the lender that says, check your loan docs, we're not helping you. We want our borrowers to be successful. We have helped them be successful over the last many, many years, and we will continue to do that. And so by being good stewards of our capital and being good stewards to our borrowers, we've built this ecosystem to know, like, and trust borrowers and get those great borrowers to come back. So that kind of takes care of the borrower bucket. From an asset bucket, we have flipped any sort of house. We have invested in any type of real estate deal, mobile home parks, apartment communities, any sort of real estate asset. We've seen it. We know it. We know how to look at the underwriting behind it. Again, funding a couple thousand loans gives you an idea of the hidden gotchas that somebody might be hiding you or hiding on a physical asset. So that's pretty straightforward. Again, I just go back to the experience. Figuring out how to be a good lender is not hard. It just takes volume of loans and time to originate them. And thankfully, we've already done that. And that's why we're here today to be able to present this out to investors as a great opportunity to get some of those kind of superior returns with a diversification of your capital across all of the loans.
Danny,
Very good.
you,
Go ahead, Kelly.
yeah, I need to add just one thing to that amazing words that he just said. Is that we have the right people in the right seat, the most experienced um, teammates have been recruited to sit in that underwriting chair to again prevent any anticipate and well not because we can't prevent any all problems, but we can anticipate problems. So the most experienced people are sitting in those underwriting chairs to add to those amazing words, Danny.
And for those of you who maybe, we sometimes talk through a lot of these different words, and we want to try to explain as much as we can, but as we're wrapping it up here, I think this webinar should help give you an idea as to exactly how we're going to be using your capital that you're entrusting in us to invest it properly and to be able to have it be protected properly and to have downside, risk protections in place. And so we're definitely excited for this fund. We're looking forward to seeing the results of the fund. But we would love to ask for you to come invest alongside us in this particular fund. So if you're ready and you want to go ahead and invest, go ahead and go over to cashflowbonds.com and register on the website there and get your first investment started. And over time you can add to your investment as well. You can add more money to your bonds and things like that. So reach out to us. Get yourself set up on the website. Thank you, Kelly and Danny, for jumping on and doing the webinar with us here. If you guys have any further questions for us, reach out. Look forward to having you invest with us alongside Cash Flow Bonds.